welcome everybody. Thanks for taking the time this evening to join us. Of course, we have the legendary Larry Williams. He's going to be sharing about 58 years of lessons that he's learned from 58 years of trading, investing, and teaching others. And this event is hosted by the Silicon Valley AAII, FinTech and Real Tech Meetup, and also the Silicon Valley AAII. So the FinTech and Real Tech Meetup were a special interest group under the Silicon Valley AAII. And those are our website links where you can find us. So again, Silicon Valley, we're a local chapter of the national organization. And the national organization has been around since 1978. And the website is AAII.com. Just a couple of upcoming events. On June 13th, we're going to have Janet Brown from FundX. She's going to be talking about investing in uncertain times and sustainable investing. And then we're going to take a summer break. This is the main meeting. So this is the Silicon Valley main meeting, but we also have the SIG meetings that are taking place, which I'll talk about in the next slide here. But the main group is going to have Janet speak in June, and then they're going to take a break for the summer and then reconvene in September. And then these are some of the SIGs. So we have a financial planning SIG, and the next meeting is June 10th, where Fred Smith is going to wrap up his whole course on financial planning. And then June 22nd, Lynn, our chairman, he's actually going to do a general investing discussion talking about what's going on in the markets and just answer questions. And then our next FinTech meeting, which is this group, so this group is the FinTech Real Tech meeting, is going to take place at the end of June. And we're going to have a gentleman by the name of David Pinson from Portfolio Armor. He's going to be talking about optimal hedges for markets using analytics. He's got a nifty technology that does that. So again, tonight, Larry's going to be speaking. And then before I pass it off to Larry, let me just give, he really needs no introduction, but you can see his bio is longer than most of our recent speakers in the past, but he's been trading futures, commodities, and stocks for 58 years. Probably his most famous indicator that he's created is the Williams %R, which is found virtually on every single trading platform, but he's also invented and created over 24 other trading and technical indicators. He was a winner of Robin's World Cup, and he actually taught his daughter, Michelle, is actually also a winner in that same trading cup. And then I think, Larry, you told us that your second daughter, you're now teaching her, and she won a competition recently.
That's correct.
Yeah, so in that competition, Larry took 10,000 to over 1 million in less than a year. He enjoys running marathons. A lot of his students, actually his previous students, are now winners in the World Cup in addition to his kids. I just asked if people can put their sound on mute, please. Thank you. And then Larry's also written a bunch of different books. He's really a Renaissance man. He actually ran for the Senate under President Reagan as well. And then I had mentioned earlier, for folks that were on earlier, that he's actually also a modern day Indiana Jones, where he along with Bob Kernook, found the Mount Sinai in Saudi Arabia, right? And so he actually has a book written about that called The Mountain of Moses. He graduated from the University of Oregon, and he's the father of Michelle Williams. She's from movies in Greatest Showman, Venom, Brokeback Mountain, Shutter Island, etc. And then his son, Dr. Jason Williams, has written a book about trading psychology and is a psychologist for traders.
Okay, well, first of all, I'd like to thank Roland and Bobby for having me here. It brings back a lot of memories when I see the Golden Gate Bridge back there. And I really got active trading was when I was living in Monterey, Carmel in 1967, 1968. There were a couple of us there that were really active traders, and we continued to trade from that time forward. And that's a lot of memories in Carmel and trading. There are kind of the old days with no computers and all that, and a lot of fond memories of coming up to the library in San Francisco to do research on the market. So with that, let's get started. If you have questions as we come along, please ask those questions. Just type them in so we don't have to go back and repeat back and forth in the slides. I'll try to answer all the questions. There might not be any. And I don't always have the answers for questions either, so I may not know an answer. I'd like to update you with where I am now in the market because that's what everybody always asks me. I went way out on a limb. We issued a special bull market buy signal to our forecast 2020 readers. And you can see the headline there. This is from the letter itself. And we went out on a limb with this forecast of the market. This is when we got extremely bullish, major long-term buy signal. And this was the forecast of what we thought the market would happen. As you know, what's happened in the meantime, of course, from that point on. But that was dated March 13th of this year. And it was time to begin buying. There was a strong rally in that Friday's close. I expect there'll be a little more downside actions, an opportunity for acquisition. So I've been extremely bullish on this market, crazy, wildly bullish on it. If you'd like to see some of that, you can go to YouTube. We did one, The Bull is Back, on March 17th. On March 30th, can the Fed stop the bear market? On April 13th, are we on the eve of destruction? The old Barry Maguire song. We played a little bit on that. And then on April 13th, my buddy Jim Cramer had me on Mad Money again, where we said the low is in. We're not going to retest the lows. At least so far, we haven't retested the lows. So that kind of gets you up to speed on where I am now. I will be showing a forecast where I think the market is going in the immediate future, a little bit later on in the PowerPoint. So you're going to be able to see that as well. What I'd really like to talk about, because my understanding of most of the people watching this, you're probably a little longer term investors than I am. I'm pretty much of a short-term trader, though I do some longer-term investing. Obviously, at the recent lows, both my wife and I bought everything we could buy, and we're still long. So we do some long-term investing, but primarily I've been a relatively short-term trader. But I do long-term stock investing, and I'd like to talk about that a little bit. The really big thing that to keep in mind is about 5 points upward drift prevails. This is huge. It took me a long time to really grasp this. My good buddy Vic Niederhofer really drilled it into my head. Stocks go up. That's just all there is to it. The stock market is a perpetual money-making machine, the best I've ever seen in my life, probably the best you've ever seen. You can make about 10% a year. If you can sidestep a bear market every now and then, you'll do better. So it's a rigged machine, really. It's just if you rebalance, you're going to have to show you the importance of rebalancing, but long-term investing is just great. Want to answer a good question is what stocks are best, value or growth? I'm going to show you there's a real difference between buying value stocks and growth stocks. I'm going to also talk about the best measure of value. How can you tell what stocks are really valued, undervalued? And I'm going to explain my magic law of the square root. This is a great little technique you can use. And I'm going to give you some long-term market timing. So those are the things I'd like to discuss with you and share with you from my research, starting way back when I did live in Carmel, way back in 1967. Wow, I really have a lot of fond memories there. I was working as a bank teller. I'd go to the library in Carmel every day and get my market statistics and numbers and go home at night and run them. We did not, listen to this, we did not have calculators. We did not have adding machines back then. It was all done by hand or a machine where you push buttons and pull down a handle, crank handle. That's how we did math back then. So we've come a long way from there. Then I'm going to talk about secrets of short-term trading, because ultimately everybody's a short-term trader. You have to buy at some point or sell. So I'm going to talk about the short-term things that I think matter and how I do trade on a shorter-term basis. So I'm going to try to cover both of that stuff for you today. Well, here's the big deal. There's the stock market. The trend is up. I mean, you would have bought any given point on that market and that chart going way back to 1900, you would have made money. Oh yeah, you had the depression back here and you took a while before you got out of it. But with the exception of about a year and a half there, we've just been up, 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 up. It looks like, but not quite, because the trend is up. I've also marked off all of the times that we've had recessions and major bull market buy signals, because if you want to avoid significant market tops, you really have to watch out for recessions. And we're in one right now. This is the battle that's going on right now. We're in a recession, but there's something else you need to learn about recessions. So here's the start of the recessions. Recently, you can see that kind of purplish line. That's when the recession started. And the blue line is when the recession is over. And notice that stocks always bottom before the recession is over. And I think that's what's happened again as well. So stocks anticipate the economy. So the economy is not the stock market. We had dinner tonight with a very astute friend of mine, an economist here in the Virgin Islands where I live. And he was all talking about the GDP and how bad it is. I said, yeah, but Warren, stock market's not the GDP. And he responds, yeah, I know. Because that's why he hasn't done so well trading. Because it's, you can't confuse these two things. They are different. So that's the trend of the market. It's been up. You know, we're on a big uptrend. You want to buy big pullbacks. However, do you know these stocks? Have you ever invested in American Can or Navistar, American Cotton, Chicago Gas, Lacklade Gas, you know, Spire, National Lead, U.S. Leather? Do those stocks ring any bells to any of you? Or Allied Chemicals, General Foods, Anaconda Copper, Corn Products, Swift? They're all in the Dow Jones Industrial Average. Now, this is a huge lesson here. If you had just bought those stocks and held on, you would not have done as good as what you see in this chart, because this chart has Google and Apple and Microsoft. In other words, the portfolio has been upgraded. And the only upward drift that exists in the market is if, in fact, you upgrade your portfolio. If you don't upgrade your portfolio, you're going to get stuck in things like General Electric or Eastman Kodak or Chicago Gas or U.S. Leather. So it's really critical you understand long-term investing, big upward drift. However, there's not as much upward drift if you don't have an updating of the portfolio to get in the newer companies and the new trends that have happened. Visa was never, of course, it's been a great stock, was never in the Dow Jones Industrial Average. We didn't have credit cards when I started trading the markets. Didn't have Microsoft, didn't have computers. So you have to always upgrade your portfolio to maintain the upward drift of the market. So upward drift prevails, trend prevails, but it's a function of upgrading the average portfolio. So, and nice is done for us by the folks at Dow Jones Industrial Average. They've done a really good job, haven't they? Look at the long-term trend of the Dow, it's up, right? Okay, well, they've upgraded really well. They kick out bad stock, put in good stock, so you can let them do that for you, free of charge. Or you could use the S&P 500, probably the top 50 stocks in the S&P 500 if you want to narrow that down a little bit. So that's upgrading. It's really important. Just know that you can't just buy these stocks and hold them forever, because there's a lot of them like Penn Central, Anaconda Copper, U.S. Leather, that didn't work to just buy and hold. So buy and hold is a myth without upgrading. So here's the big thing. Whenever I go to a cocktail party or lecture, people say, Larry, should I buy value stocks or growth stocks? What's better, growth or value? It's a really important question. Probably perhaps the most critical of all questions that you can have as a longer term investor. So what is it? Which wins, value or growth? It's a surprise. But let the numbers speak, not my opinion. I'm really a research guy. I'm a numbers guy. If we look at Morningstar's value versus growth, this is a study I did for my stock course in 2006, and I'll update it. You'll see that in a moment. If we looked at small growth, did in 10 years, did 10%. Small value made 13.69%. Large growth made 9.1%. Large value made 10.9%. This is just crazy, but value always beats growth. Growth, you think, well, growth's going to be better than value, right? But the numbers themselves are real clear. A value investor does better over a longer time period than a growth investor does. Again, we've got some more current data. The annual return in the U.S. market in value 16.2%, growth 11.3%. That's huge. Large or small. So it's something you really need to think about in terms of your investing is, are you going to be in large growth or uh, large value or small value? And the bottom line is small value and small value and large value actually beat growth stocks. I'm going to stop for a moment here and try to bring in questions if there are questions. I think I cut my chat screen down, so let's see if we can get that back up. Roland? No, if you see questions coming in, Roland, let me know. I've lost my chat
Yeah.
screen here.
Let's see. I don't see any questions
Okay,
so
good. Maybe
far.
that's why that. Okay.
Yeah.
Okay. So here's another relationship of value or growth. This is 2000 to 2020. Now remember, my research was done in 2006. The value is shown in the green dots, and this is the percentage of volatility and the risk reward. Which does the best? Well, look at that. The green dots are out here. They do better than growth. So whenever I look at this data, and you can do it yourself, go look at Value Lines funds. Who's been the best? Value or growth? Value or growth? And it's so strange because intellectually we think, well, growth will be better than value, but the reality of the marketplace is that value does better. Maybe that's why that old adage that I learned so many years ago is that money is made on Main Street and lost on Wall Street, because people really don't know how to play this game. And my hope is to teach you a little bit about how the game is played tonight. Okay, so let the numbers speak. With a 25-year annualized return of 10.9%, 10.96%, small cap value, that's the average of the Russell 2000 value in the Lipper, turned $10,000 into $135,000, $53,000 more than small cap growth. It's just shocking. Even now, I mean, I know this, but I read it. It still intellectually sounds to me like, well, that shouldn't be. Growth should beat value. But the truth is, value does beat growth. And so it's a really important number for you. Small cap growth had an annualized rate of return of 8.7% versus 10.96%. The money to be made as a long-term investor is value. So what we need to do is, how do we find value? What value measures could we use that would help us understand value? There's a lot of them. Debt matters a lot. This is a study that we did. We're just going to buy the 5 highest debt to equity stocks in the Dow, see how they did. We're going to buy only stocks in the Dow that have a lot of debt. And they do about 7.3% on an annualized basis, high debt, okay? And then if we do low debt, they do 11.8%, almost 12%. So low debt stocks did about 12% and high debt stocks did about 7%. So clearly debt matters. And it only makes sense. If a company has a debt, they can't put money into research and development and hiring better people. They got to pay off the bankers. They have to pay off people, right? So that's a good measure of value is debt. I don't like large debt companies. I like companies that have very little, if any, debt at all. Debt is a detrimental to your performance. Ben Graham was right. Price book also matters. And most of you probably read about price book and all this stuff. I'm not going to spend a lot of time on it. But we updated the study from his original studies, and we found the same thing. The five lowest price to book ratios stocks in the Dow did on a 9-month basis about 14.1%. The highest price to book ratios 9-month did 18%. So price to book ratios really matter. They also make a difference. So there are fundamentals. This is one thing people don't realize. They usually see me as a technician. I'm that a little bit, but I really think that fundamentals are the driving force of the market. Markets move from here to here for fundamental reasons. They dance around like that because of emotions. We can capture those emotions with technical stuff, but the driving force is the fundamentals of the marketplace. Well, return on equity, how much money a company is making, also matters. Here's another study that we did. This is our personal studies, of course, where we did a holding period of the highest return on equity stocks in the S&P. And those did 17.5% a year, which is obviously a lot better than the ones that had a low return on equity. So things like that can really make a difference. How much of a difference? Well, we look at the 25 lowest ROE stocks in the S&P. they did about 12.3%, while the high ones did almost 18%, so about a 6 percentage point difference. So again, it drives home the importance of fundamentals in the marketplace. Now, a lot of people want to buy a stock like Apple or Google or Amazon because the hot stock is a good growth stock. That's a whole different game than the consistent game that I like to play. I want to find value. I want to hold on to value. I want to reevaluate that if I have to upgrade my portfolio. The problem with growth stocks, they boom and they bust. All those stocks you looked at earlier, they were growth stocks. U.S. Leather was a growth stock. General Electric was a growth stock. Penn Central was a growth stock. They were all growth stocks, but growth stocks die real easily. So let's talk about the law of square root as well. This is really an interesting thing for those of you that enjoy math. I think you might like this a lot. What's the law of square root? It's a really important law you should know about in the stock market. It makes a big difference. Let me show you. Stocks move in equal increments of their square root. That's the general understanding I have mathematically, that stocks move up and down all over the place, but they seem to move in increments of square roots. Does it matter? Hugely. A $100 stock will move to 120. That's one square root. A $4 stock, one square root, will move to 6. Conceptually, that's to say low price stocks move more than high price stocks. A $4 stock moving up one square root to 6 is a 50% gain. A $100 stock moving up one square root is a 10% gain. So if I'm correct in my assumption that stocks tend to move in the law of square root, they tend to move in square root units for whatever reason, but that's what our studies show. The potential return, which is what we're interested in, the percentage return, substantially higher. One square root is 50% of the $4 stock, 10% on a $100 stock. So the truth is that lower price stocks tend to have smaller percentage down moves as well. They can only go down so far, right? So if you have a really quality stock, a value stock, as we talked about, that's low priced, your basement's limited there, how much you can go down, and the upside is unlimited, and you should move in the law of square root, which means you should have substantially better performance. Well, let's look at that. Is it true? Is there proof for this? Is there data for this? Yes, there is. Let me show that to you. So we're looking at the annual return of the various holding periods, 3, 6, 9, 12 months, excuse me, buying the highest 10% stocks in the S&P. We took the 10% stocks that were the highest price. Didn't look at anything else. Didn't look at price book, valuation, price sales only. We wanted to buy the highest price stocks in the S&Ps. And during this time period, which was a few years ago, the average gain was 14.79%. Not bad. Then we looked at buying the lowest price stocks in the S&P. Again, who cares what they did? Didn't care, made money, lost money. Only criteria was their low price stocks, and they did 20.3%. Yeah, the law of square root seems to be working in the marketplace. Low price stocks tend to have large percentage gains. As an investor, that's what I'm looking for, a percentage gain, a return on my money. And I know I'm going to get a better shot at that with low price stocks. Okay, let's switch gears for a little bit. I want to give you a way you can evaluate the market. What do we expect the market to do now? Fundamentally, where are we undervalued or are we overvalued? This is a great little formula. I'd like to share that. This is from our stock course. You're going to take the current PE ratio of the Dow, you're going to multiply that by 0.57 and subtract that number from 20.67 and compare to the average return of stocks, which has been about 10.46%. I'm going to give you an example of this, obviously, but there's the math. You'll be getting PowerPoint slides of all this, so I want to show that formula. And currently the PE is 19.9%. If we multiply that by 0.5%, we get 11.39. We subtract 11.39 from 20.6 and we get 9.28. Well, the average return has been 10.46%. So with this PE ratio, the expected return based on P is 9.28. We actually should underperform the average. So we should underperform by about 1.18%. And this has been a really good tool for me over the years. At the first of the year, we run this every year in my annual forecast report, and we got a good idea how strong the market will be, or even during the year, like right now. So, the PE ratio is not real conducive to a market. So we're probably going to have a bull market or a big up move like I talked about earlier, but it can have a lot of weakness in it along the way as well as to self-correct. Well, PE ratios get better or worse or whatever cards are flopped out on the table for us. But if you want to have a good idea of the fundamental value of the stocks, there's the formula for you right there. Hope you enjoy it. Okay, so long-term market timing. How do you time the market? How do you avoid these big bear markets? Well, fundamentals, as we've talked about, I think cycles are really important to help us understand primarily when to buy stocks, not necessarily when to sell them, but there's cycle lows tend to be about every 4 years. The decennial pattern that Edward Lawrence Smith wrote about. Warren Buffett said he's one very smart man. You should definitely know about the decennial pattern and the seasonal influence of stocks as well, because there's usually a good time to buy and a good time to sell. What I have found is there's not very many technical tools that call market tops. Now, I looked for, 40 years for all the technical stuff that would help me identify a market top. I couldn't find anything really, but I did find fundamental ones. So I think market tops kind of go up and up and up and up, and then gradually they roll over as the economy gets worse. Market bottoms, price come down, boom, come right back up. So you can use technical stuff to identify market bottoms, but not market tops. Market tops are fundamental data. I think better called market tops. So what can we use? What are the indicators I use? Unemployment, employment or unemployment, the yield curve, critical, going to show that to you tonight. Interest rates, and the Fed, the Federal Reserve. Oh my gosh. What a storehouse of knowledge these people have. Most people don't know about it. Forget my books on trading or anybody else's books. You better read what the Fed's doing. They tell you what's going to happen in the economy and most likely what will happen in the market. Here's a great recession indicator from the Federal Reserve. This is the Federal Reserve Bank. It's called the Sham Rule Recession Indicator right there. You don't have to subscribe to anything. You can get it from the Federal Reserve of St. Louis. And you can see, oh, it just tipped into a recession now. You can see it, how this indicator is turned up before all the recessions that we saw in the past. So if you want to know if we're going to enter a recession, there it is for free from the Fed. The Feds also have a great market sentiment indicator. AAII has a really great market sentiment indicator as well. It's what you guys are most known for. The Federal Reserve has one as well from the Federal, this is the Federal Reserve Bank of San Francisco. And they also have a market sentiment index. And look what it just did. It just went into the buy zone, where it was back here at the end of this recession, end of this recession, end of this recession. Just got an overwhelming amount of negative sentiment in the market. So the Fed has a lot of market data. People just aren't aware of how much stuff is on the Fed's website. Here's the big thing. I mentioned this earlier. GDP is not the market, so don't get too concerned here that GDP sucks, because it does. But here's a report from the Federal Reserve System. And the Federal Reserve said that they saw no relationship between gross domestic product and the average increase of the Dow Jones Industrial Average. The real GDP is a red line, the Dow is a blue line, and they found no correlation between it at all, which really makes sense because the markets are anticipatory of what happens in the economy. The markets top before the coronavirus, they bottom before this thing is over as well. So don't get too carried away with just GDP. But this is it. Stocks bottom before the economy. Look at this chart from the Federal Reserve System. Drive this home into your memory. Here's the market low and the unemployment claims. That's how bad the economy is. Look what happens. The market bottoms here, then the employment starts to get better. The market bottoms here, employment turns down. The market bottoms here, then unemployment turns down. The market bottoms here, unemployment turns down. The market bottoms here, later on unemployment turns down. The market is anticipatory. We're going way back to 1970 now. And what we've seen is the market bottoms prior to these numbers getting good. Well, the numbers have been horrible that we're looking at right now for the most part. But the market anticipates that the market can actually bottom before we get the good, so-called good economic news. I suspect that's what's going on now. Excuse me. Also, the yield curve. Oh, you got to follow this. Another thing you can get for free on stockcharts.com. This is the yield curve in 2002, before the big bear market, 2001, before the bear market began. There's the yield curve in red. It's coming down. A negative or deep downtrending yield curve is really negative for stocks. Oh, a bear market. Keep that visual in mind. Here we are at the start of the 2007, 8, and 9 bear market, yield curve flat and down. That's negative. You'd probably like to know where we are now, right? Well, here's where we are right now. We're right up here. The yield curve is an uprising yield curve. It's a positive yield curve. It's bullish for stock prices. So fundamentals can help us call market timing. I think cycles can be somewhat helpful for us, and the seasonal pattern of the market as well. The long-term cycles that I use are 2-year, 4-year, and a 10-year patterns. Those seem to be the most redundant patterns in the marketplace. About every 4 years, we get a market low. If you go back, when I first started trading in 1962, you go forward 4 years and you have the 1966 low. After 1966, 4 years, you have 1970 low. After 1970, 4 years, you have the 1974 low. Then you have the 1978 low. Then you have the 1982 low. You'll find any market, major market low in the market, move forward about 4 years, and you're going to see another market low. So the 4-year cycle or pattern has been really strong, something you should be watching for. And the decennial pattern I mentioned earlier, of course, and finally the seasonal pattern. Well, here is the seasonal pattern for you of the S&P E-minis. Typically, this is the first of the year right here. We start the year kind of choppy, come down, move on up into a high in July, come down and have a low in October. That's usually what happens in and out most every year in the marketplace itself. Now, that doesn't mean it's going to happen this year, but it's a general roadmap we can look for to see how are we doing this year. Are we close to the roadmap? Are we stronger than roadmap? Are we weaker than roadmap? So use it as a tool, not, oh, buy here, sell there. Now, this is a true seasonal pattern of the stock market. In 1960, the best time was to buy in May, and then the market rallied up until December. So these things can change. Now, remember, we just saw the current market, which usually people said sell in May and walk away, right? That's the old seasonal adage. Well, that didn't work until about 1965, 1955, 60. The seasonal pattern started to change. As you can see, you wanted to be a buyer in May. So this pattern can change. I believe that we're locked into a good pattern now that we usually are going to see weakness in May and strength in late September, probably because of the Federal Reserve System. We didn't have a really active Federal Reserve System until about 1950, 1955. And most all the data changes at that point when the Federal Reserve System started to really use their muscle and really come in and exert influence on this economy. So keep that in mind, that the seasonal pattern can change, and the one we have now is not at all what it was years before. Well, you probably want to know what I think, where we're going to go now. This is our fundamental forecast. This blue line is something we've been working with on my weekly market commentary since way back in February. This blue line is essentially a long-term forecast based on interest rates of where stocks should go. And as you can see, this is a general, it looks like a really big up move coming in September of this year. That's a longer term forecast. We actually started using this forecast back here. Done a pretty good job of generally telling us the direction of the market. One reason that we got really bullish right here, I actually bought the absolute low day in the S&P 500 in my own account. The gold line is another fundamental factor that's a shorter term, what should happen in the market. So you see short term, it really called the low down here very well, called the rally up here that we've seen, caused a little bit of a pullback in here, and then we take off again to the upside, another buying opportunity and another rally. So you want to get a kind of a short-term view, and this is not technical or cycles, this is fundamentals. These are things that influence stock prices. Interest rates influence stock prices, crude oil influence stock prices, gold influences stock prices, Fed funds influence stock prices. Those are real things. They're not just numbers on people's charts. Moving averages and lines and stuff like that are not quite meaningless, but there's a lot of mumbo jumbo in this world of technical analysis, which you can see why I like to work with fundamental stuff. Okay, short-term traders. Let's go to short-term trading for a moment. A lot of people like short-term trading. especially now people are locked in. Everybody wants to day trade. My gosh, I went in the post office the other day and people there wanted me to teach them day trade. I go, wow, really? I was in a restaurant having dinner and somebody came up and they want to learn how to day trade. I was like, oh, it's not as easy as you think that it is. Here's why. Never forget this rule. Trend is the basis of all profits. That's a staggering thought. If there's no trend, will you ever make a profit? No, you won't, will you? You've got to have a price have moved from here to here. That doesn't matter if it's real estate, commodities, stocks, whatever it is. There's got to be a trend or you will not profit. So trend matters. So it is anti-trend. And what are you going to trade as a short-term trader? Stocks, commodities? Where's the easiest to make the money? And what tools are going to help you? Those are questions I'd like to try to answer for you now. Well, I use some indicators, and I'm going to show you some of those. But when I look at people's charts and I go, wow, you got so many indicators on there, and they're redundant. I want each indicator to have a specific tool on my chart. I want one to show me the trend, overbought, oversold. One to show me if momentum of price is accelerating or deaccelerating. I want to know if smart money buying. Clearly, we can prove that there is smart money in the marketplace, and we can track these people with a commitment to trader report, with accumulation techniques in the market using volume and price and open interest. So when these people start buying, we should probably be buying too. Seasonality, I showed you a little bit about that. And there are some chart patterns that I found really useful. Not a lot of them, I wish there were more, but there are some chart patterns that are really quite good to help me get into or out of the market. And of course, cycles. So those are short-term things that I use. Here's an example of accumulation in the marketplace and my seasonal index. Here's the seasonal index. We should start to rally usually and follow the blue line here. And the red line is accumulation in the marketplace. Notice at this low, the reason I bought right here, this day's low, was accumulation. While the market was making lower lows, on this decline, there wasn't much selling. Look at the divergence in here and the divergence at the top. And then we saw some divergence in here before we started to come down. So I look at divergence between accumulation in the marketplace and price structure itself. Here's another example of gold. As gold drove up to new highs here, one rally, two, three rallies. Look at the big guys were getting out of the market. Look at that. They didn't follow this rally and the market came down. Just before the big rally to the upside, though, we saw the opposite. Price is coming down in here, but accumulation is higher. We're diverging. We have a higher price, higher accumulation here than we do price. And here we saw the reverse. Price looks strong, but there's no accumulation in the marketplace. So I use that a lot for stocks or commodities, professional accumulation. I also use a commitment to trader report. This is something you can use for stock people as well. The government issues every week something called the commitments of trader report. It shows what the users and producers of the commodity are buying and selling, how much they're buying and selling, what the small speculators are doing, what the funds are doing. So I know every Friday how much buying was done by the commodity funds or by the people that are selling wheat or buying wheat to make crackers or Wheaties out of. So those are the commercials, and they've pretty good record of being right on the marketplace. We're long, non-commodity people look at corn right now. We're long corn. It's had a really nice rally because the commercials were big buyers in this marketplace. So the commercials is the red line down here. This is the actual buying and selling of the largest players in the marketplace in crude oil. And when they get very negative as they were here, oh, look at that price of decline. You know why that massive decline in crude oil this year? Well, look what, they were big, heavy sellers up here. What I found over the years, because I started working with this in 1973 when I was in Carmel, I can emulate that with an index we call COTSI. This index is a theoretical index of what the commercials are doing, and it pretty well follows what they're doing. That's really cool because we know how they're buying commodities. We could use that for stocks. Now here's the commitment to trader report for the E-minis and my theoretical index. Look, there are buyers here, buyers here, buyers here, buyers here, and buyers back here. So we can use this on virtually any freely traded market. Here's Google as an example. Here's the index of how, if commodity professionals were buying Google, they would have been buying Google in this area, and this area, and this area, and selling up here. So this theoretical index has great application for stock traders, because what I found is the commercials buy commodities in a certain special way. They accumulate. They just don't chase strength. They accumulate on weakness. And I was able to develop a formula from that of, we can take that into the stock market, and we see the exact same thing there. Clearly, smart money buys stocks the way smart money buys futures. So we have a great index for stocks for intermediate term trading. Here's Costco. And again, you say, oh, look at that. They're buying right here. They're heavy buyers there. Their buyers been here, buyers at the low. I mean, what a great tool to have to get us on the right side being with the large people. One of my very favorite indicators for determining if we're in a bear market rally, false rally, if you will, or in a really strong bear market or bull market, is the advanced decline line. This is simply the net difference between advancing and declining stocks, cumulative on a daily basis. And you can see big divergences. This is the start of the 2007-8 bear market. New highs in price up here. Look at that. But not in the advanced decline line. Stocks couldn't advance. The bear market began. Now it looks like a good rally here, breakout. All the technicians went crazy. We broke out the highest high the last 50 days, 100 days, whatever. But look at the advanced decline line. It didn't break out at all. It was miserable. And another what looked like a good rally, the advanced decline line couldn't rally at all. Look at that. And of course, then the market just really tanked. So I like to look for advanced decline line divergence. I've been looking for it in the market now. We had a little bit last week, but boom, we came right back on track. No advanced decline line divergence right now in the S&Ps. You see what happened at the recent high in the marketplace. We rallied to new highs. Advanced decline line was much weaker. Saw the same thing over here. Advanced decline line is weaker. We rally up, and we had the big sell-off in 2019. It's a really good tool. It's a little subjective. You have to read it, but it's worth reading. Okay, Tom Cruise said it best, show me the money. Where is the money as a short-term trader? You know, we're going to learn tonight. The biggest winners, short-term traders, been in futures, then Forex, then options, and then stocks. My point being, if you want to be a real short-term trader, I'm not talking day trading now, I don't day trade. A trader who wants to trade from maybe 3 to 10, 15, 20 days in the marketplace. The real money has been made in the futures market. Let me show you, let me prove that to you. This is the 2009 World Cup Trading Championship. Forex traders, the best one did 113%. The best futures trader, one of my students, did 266%. The second place in futures trading, another one of my students, was up 183%. He did better than the first place in Forex trading. In fact, the last place, another one of my students, Dr. Sebastian Baumgartel, was up 97%. He would have taken second place in Forex trading. Now, maybe that's just an exception. So let's look at a couple more years. If we look at 2018, the futures trader was up 257%, another student, and the Russian, another student, was up 200%. But futures traders beat again. In fact, look at it, the second and third place is up 58, 57%, better than the Forex traders. And you'll see this consistently. Oh, and there's my daughter, Paige, my youngest daughter, who in a 3-month trading competition was up 32%, trading the S&P 500. So the money, if we look at futures trading versus Forex trading, futures traders have always done better in terms of trading. In real time, real money, these are good traders, by the way, with real money. This is real deal stuff. That's where the money's been consistently. And if we go back and look at stocks, Chuck Hughes, who started with me, he's done a lot of stuff now. One of the best stock performers ever in 2009 was up 122%. Futures up 115%. Andrew Younger, another student, up 672%. Stocks up 48%. Stocks up 229%. Chuck Hughes again. Michael Cook, another one of my friends and students, up 250%. we just consistently see stocks up 73, futures up 107, stocks up 30, futures up 278, stocks up 26, futures up 929%. As a short-term trading vehicle, I know you guys and gals are stock people, but on a short-term trading vehicle basis, clearly a lot more money has been trading futures and stocks. So where are the big gains? Where's the gold mine? It's in the futures market as for traders. So where the big money is, I want to talk about trading systems. There's a lot of mechanical trading systems out there and strategies. Great traders are not system or mechanical based. I know the best trader that I think's ever walked on this planet who manages billions of dollars. He's not a systematic trader. He doesn't trade a system. I know systematic traders. Look at the mutual fund performance. A lot of those are systematic traders. They do in a good year 10, 12%. Well, that's not good enough for me. Discretionary traders do better. So a lot of people, a lot of mathematicians love to develop a system and have a mechanical trading system. They can make money, but they'll never knock it out of the park with the big, big returns. Big returns from understanding the markets and being a discretionary trader, learning the art of trading. Well, I do teach a little bit. I hope we have more to come. This is just our first short little plug. I do a weekly market commentary. It's $29.95 per month. You can go to our website, ireadytrade.com, and we also have a stock and futures course. Okay, your emotions of the marketplace are the big thing that you really have to be careful of in the market. And
Larry?
Yes.
We did have one question come in. Can we just take a...
Absolutely. What's the question?
Yeah, there's a question from Andrew Bennett, and he says, last decade, the number of available U.S. stocks have decreased due to mergers, going private, and maybe Sarbanes-Oxley overhead cost. How might the lower number of available equities impact the future versus the past?
Well, Andrew, I wish I knew. I don't have the answer to that. I don't have the data, so I have no idea even of a correct answer to that. So I'm sorry, I got to pass on that. I have seen that debated quite a bit. Some people say it does have an impact. Some say it doesn't. You know, I haven't found that to be a consistent indicator. So unfortunately, I don't have an answer for you. My apologies.
Larry, I've got a couple of questions.
Please, Bobby.
Bill has a question. Are FANG value or growth?
Pardon?
Are FANG stocks, so Facebook, Amazon, Netflix, Google?
I think those are growth stocks.
Yeah.
And they can, you know, they've done great now, but they can break, they can crack. And that's been my experience when I first started. These great growth stocks, now suddenly they stop growing. The real point about the great growth stocks is it easy for somebody to compete against them? It was easy for somebody to come compete against, say, Starbucks. It's tough to come compete against Google or Amazon. They own that market now. So those have a unique growth factor to them that I think separate them from a growth stock like Chico's clothing store was a real hot stock for a while. Well, anybody can get in that business and do what they did. So if it's something that the cost of entry is getting in is easy, you know, you got to be very careful of growth stocks. Value stocks, Procter & Gamble's, you're not going to knock them out of the business. They're going to be around. So a value stock, probably why they're value is because nobody can compete with them. They can't get in that business very easily. Was there another question, Bobby?
Yes, one more. Regards law of square root, does it show that stock splits that reduce stock price result in higher returns?
Correct.
I'll repeat it. Regarding the law of square root, does it show that stock splits that reduce stock price result in higher returns?
Well, if there's a stock split and the price was at a lower price level, then it would be able to move up one square root and would have a larger percentage gain. But that's kind of a separate question. Do stock splits matter or not?
Yeah.
Well, sure. If it gets a stock to a lower price, the law of square root is going to kick in. And again, probably shows why all of our data shows going way back. I've been doing this law of square root for 50 years, that these low price stocks have larger percentage gains.
Makes sense. Larry, do you want to take one more?
Sure, please.
All right, all right. Where did you get the current PE for the market of 19.999? Yeah.
That
for your
was from the
quote
Dow.
there.
Yeah, that was from the Dow Jones Industrial website a few days ago. It might have changed a bit now, but I believe that was a 12-month forward PE ratio, which is what I work with, because the Federal Reserve, for their model of stock prices, uses the 12-month forward PE ratio. That's one you want to use. But it was from the Dow Jones site. You can go to Google Dow Jones PE ratios, and they list it there every week. It's also on Barron's.
Got it. That's it. All right, great. Thank you, Larry.
Okay, well, let's talk about your emotions on the marketplace, because if you've invested in anything, you've gotten emotional. It doesn't matter if it's real estate or stocks or commodities. This can be a really emotional ragtag affair. So how do you control your emotions? My son is a psychiatrist, has worked with a lot of traders, and we really figured out, Albert Einstein had it all figured out. This is all the formula you need to know. Einstein must have been a great commodity trader. His formula E equals MC squared is it. This is the formula for you for money management. The father of money management. There he is, old Albert, right? There's the father of bad money management. Let's see if anybody recognizes who that is. If they do, they can type that in, and then I'll tell you later who it is. So here's EM equals MC squared, and here's what that formula is. Money management is really emotional management. The more you have on the table, the more emotional you're going to get. If you're investing every single penny you have in the marketplace and the market moves up a little bit, you're going to be really happy, down a little bit, going to be really sad. Your emotions are a function of your risk, of your bet size. So E equals MC squared, emotions equal money you have squared by the number of contracts or position you have, your position size. Your emotions are simply a function of how much money you have and how big of a position you have in the marketplace. So if you think you're too emotional, it isn't the markets. If you didn't have a penny in the market, they wouldn't bother you. You have too many pennies in the market if your emotions are out of control. So to cut back your emotions, figure out where's your emotion quotient. And there's no magic formula to this. There's a lot of great money management formulas, but they're not emotional management. What I'm giving is emotional management. You need to say, well, I can list, in my case, I can lose 10, 15% of my money in one trade. I don't bother me. I'm a professional trader. But a lot of people can't do that. They want to risk 2% or 1% or whatever that number varies. That'll vary in your life. When I was younger, I took a lot bigger risks than I do now, and didn't bother me then. So it's a number that will change as you get better, as you get older. But that's your personal number, but it's really an important number. You need to figure that out. At what point is my position size so big that I can't think straight, I can't act well? That's the emotional management number you need to figure out for yourself. Emotional resilience comes from not betting too big and trusting in yourself. If it's all about your bet size, that determines your emotions. I think we're going to wrap it up with that. Yeah, if there are other questions, I think we've been on, probably bored you long enough, almost an hour here. So if you have other questions, I would like to thank you for having me here. And if other questions have come in, I'd gladly answer them. Or you can always go to our website, ireallytrade.com, because I really do trade.
Roland, I don't know if you got any responses for who the other picture was, but I got one response, and I can share that with the folks.
Yeah, go ahead. I did get a couple of responses, but you go first.
I got the obvious one, Bernie Madoff.
Okay.
No, it wasn't Bernie Madoff. Oh, that's good. Let's go back. Let's see what that was. I'll give that again. Who is that?
Bernie Sanders.
Bernie Sanders. You got half of it right. Yeah, it's Bernie Sanders.
Very nice.
My brother's a big Bernie Sanders backer, right? We have discussions about that. I wonder what his money management policy would be. But that, I wonder if anybody would pick up on that old picture of Bernie Sanders.
Well, Why do you say he's a bad money management, Larry?
Well, because he wants to spend my money.
Oh, got it.
Yeah.
Yeah. So I got some questions about, where is the recording going to be found? I posted, so it's going to be posted on the AAII YouTube website, and which Celia provided. So I'm going to post it again in the chat here so you guys can pick it up from the chat. That's the link. And so we should be posting that in a few days or so. Holly from our team is going to be doing some edits, and then we'll post it. There's another question that came in, Larry, is on average, how much time do you invest before you decide to make a trade? So I guess, how long do you decide in pulling that trigger? Like, that decision making to go into the trade or not? How quickly?
Sure. Let me break that down, I think, into two parts, just I'm not totally clear. It may be a long time. Like we've been waiting to buy the REITs for a long time. We wanted a big pullback in them. So waited a long time. And then when they broke in the decline we saw in March and April, then we stepped in and bought. And that was a decision, was just a matter of like, oh, they're getting beat up. We're going to step in and buy, and they're way down at unbelievable prices. But we've been watching for a long time, waiting to make that decision. So that would be a longer term investment decision that was made, right or wrong. But it came with first a wait. And then when we saw the condition, boom, we're in it. In terms of my personal trading, like I bought, I think, gold tonight, and I'm long corn. Well, I looked at the charts this afternoon and figured out, where I had buy signals and sell signals, and placed my orders. Yeah, I did buy gold tonight, and placed my orders. And so that's a process probably every day, 45 minutes or an hour. As the markets are closing, I got prepared to place my orders.
Great. Thanks, Larry. And then another follow-up question is, does that decision-making time frame change when you do short-term versus mid-term versus long-term trades?
Well, in my case, what I do is I spend the weekend setting up trades for my shorter-term trading. And then I may or may not take those trades the coming week, again, spending 45 minutes maybe after the markets, as the markets are closing. But I do my homework on the weekends, and then I'm prepared to go to battle during the week. My longer term investing things, I mentioned, we've been waiting to buy Costco for a long time. We wanted to get it beat up. Or if we see a lot of accumulation, one of my favorite stocks, JK Henry, great, phenomenal stock. Oh my gosh. Nobody knows about this stock, probably the best growth stock ever. Nobody's ever heard of it. And so we waited for a while, and then we saw accumulation come in the market. So there it's kind of like, oh, we found something we really like, but we want to, like everybody, we want to buy it cheap, right? We want to buy it when it gets beat up a little bit. So we have some protection from a downside move. So then we wait for some of our indicators to click and say, yeah, let's buy it now. It's under accumulation, or it's oversold. So it's really a combination of a lot of patience. You got to be patient to do this. I mean, we waited so long to buy the REITs, and then you got to pull the trigger. And you're always afraid to pull the trigger because now it's down. And nobody wants to buy something when it's down. But you have to say, yeah, I got to buy it. That's what we're waiting for it to be down.
Okay, and then thank you. And then another question is, Larry, what's your view of value stocks, given that in the past 5 to 7 years they've been underperforming, I assume, growth stocks significantly?
Well, I don't think they have been. I think if you look at the data, I showed some of for just the last few years, value stocks always, they're better bet. Value stocks will outperform growth stocks over any given time period of, more than a couple of years. So, to me, I want to work the odds here. Where do I have the best bet? As a short-term trader, obviously commodities. As a longer-term investor, value stocks outperform growth stocks. I would love to see somebody show me good data that over the last 5 years, growth stocks have outperformed value stocks, excluding Google, Apple, et cetera, about 4 or 5 stocks. Toss those stocks out. If you weren't in those stocks, you're just look at the Vanguard value funds versus the Vanguard growth funds. There's the answer. Which did the best in the last 10 years? I think you're going to find its value.
Okay. And man, the questions are really coming in now. Someone asked, with most of their investments in mutual funds and, it's fairly well diversified, would you recommend options to hedge against the downturns?
I don't know enough about options to write options against your position, so I'm not the best person to answer that question. Again, I apologize, but that one's over my head. My wife does a lot of option writing. I understand basically, but I'm not experienced enough in doing that, so sorry.
Yeah. And Steve, our next speaker next month at this FinTech Realtech group, he's going to be talking about using analytics to do an optimal hedge using options. So just FYI. Prakash is asking, how do you measure accumulation?
Well, there are a lot of ways. A basic one everybody could follow is something called unbalanced volume that is in most of the chart services. It was popularized by a friend of mine, Joe Granville, passed away a couple of years ago. It was really developed by a guy and his wife there in San Francisco. Woods and Vignolia were a couple in San Francisco that came up with this idea of cumulative volume. They're just adding today's volume if the market's up, subtracting if it's a day down. And Joe Granville popularized it under the name unbalanced volume. So that's a simple one. It's in every quote book. Then you can go into more sophisticated ones where you look at the relationship of the opening price or the middle price or the closing. And we've got formulas that do that. I've written those are in my books. You can read about those in the books. That's another way of measuring accumulation in the marketplace. But really looking at price change and how price came into the market today relative to volume.
Okay, thank you. Phoenix is asking, so he had a question about options, and so I think Phoenix, Larry doesn't really buy options, but the second part of your question was, Phoenix is asking, can growth stocks become value stocks? And if so, when? And is there a signal to kind of determine when they switch from growth to value?
Sure, they can, and I definitely don't know the answer to that, but you bet we have seen growth stocks. Microsoft was a growth stock and it's more of a value stock now. IBM at one point was a growth stock and then it became a value stock. So yeah, it does happen. Probably might have something to do with capitalization, might have something to do with earnings, but is there like a light switch that goes on and off? I don't know. I will say this on options though. Here's one option strategy that I have used, and it's a really good option strategy. If you have the patience, the option strategy is this. You want to find a stock that's in a downtrend or a commodity. And then when you get an excessive bullishness, bullish percentage of newsletters that are bullish on the stock or the future, then you can write calls because that stock most likely is going to go back down. So big downtrend, excessive optimism, you can write calls on that because you can expect the stock to come back down. That's been a successful strategy that I do have personal experience with.
Okay. Great. Someone's asking, is there a time of day where you make most of the trades? And then he's asking, I guess he answered his own question, why at closing? So,
well, I watch the markets around the close to figure out what I'm going to do tomorrow. And then I place my orders. Actually, I placed my orders, and I placed my orders tonight, and we went out and had dinner, and we came back. I'm 3 hours ahead of you guys. It's pretty soon will be 4 hours ahead of you. So that's just my trading style. It fits me. I go to sleep, my orders in the marketplace, I get filled, I wake up and go, oh, what happened? Or yeah, something really happened good. But I don't watch the screens like, oh, and buys here, sell here. I haven't found that to be profitable. And frankly, I have not seen any long-term successful day traders that have consistently made any substantial amounts of money day trading. So I'm not interested in that. The secret to making money in the market is to have a small position and capture a big move. If you can do that, you can have a lot of losing trades because you're going to lose small. The only way a day trader can make much money is to have a big position and catch a little move. Then he can make money. But on the big position, he has a loss that's going to be bigger than his profit. A day trader is limited number of hours, 5 hours, that's 6 hours. That's it to make money. I have unlimited time. I bought corn a while ago. I've got a $27,000, $28,000 profit in it. And not much of a commitment to the market either. But I have time. This corn trade might last 6 months. It might last another 2 weeks. But time is my ally. I want time. Day traders say, oh, I only have this much time to make money. Well, not me. I want a lot of time. Time is a creator of trend. No time, no trend. So time is, I'm place my orders and walk away from it. I'm not looking at all the little stuff going on in the marketplace.
Bree has a question. Bree, the slides are going to be made available, and also a recording is going to be made available, so you can review those slides to your heart's content. So we won't go back to those slides right now. And then Sundar has a question of, do you see the market being more bearish with a huge upswing in September? If so, what is your reasoning? I think he was going off. Yeah, he was going off.
I was looking at those charts. I think that we continue to be in an upswinging market. I expect a little bit of a dip here and actually a sharp dip and right back to the upside. I think we're going to make new highs in these markets. So I'm one of the few crazy, wildly bullish people, and I have been. And you can look at the videos that I gave. You can see a lot more of my reasons why. I don't think we'll see a retesting of the low either. So, I'm a long-term bull. Nothing has come in my work that suggests we're going to have a major, massive sell-off here. Now, it might, but as of today, the trend's up, and I want to be a buyer of pullbacks. And I think we'll see new highs in the Dow Jones Industrial Average and the S&P 500. Will we exactly how that happens? Nobody knows. I don't know. But the bigger move, that's the bigger move that I believe we're in now. And there's been no technical deterioration in this market that would suggest otherwise.
And then the last question I have here is Phoenix was revisiting that options question. And when you mentioned that you sell some of those calls, he was wondering, how far out do you buy them? Do you buy them out, weeks or months? How far out do you sell those covered calls?
I want to sell just about in the money. I don't want to be way out in time. I want to have decay working in my favor.
The slides will be made available. So I'm getting multiple questions about the slides. Slides will be made available, and I posted the link. Let me post it again here. It should be available in the, this is the link for the, or the YouTube channel for AAII. And then also I'll send out an announcement via Eventbrite. And I think, Bobby, you had some questions?
I have, Larry, let's make this the last question. It's from Mary, and she's asking, are you concerned about the enormous amount of money being printed, and how we can deal with that?
Oh, I love it. The enormous amount of money is not inflationary. First of all, that's a big fear. The Federal Reserve has just focused themselves on getting this economy going again. How do they do it? They pump money into the economy. It's like a car. You can put the foot on the brake or foot on the gas pedal. Right now, the foot is off the brake. It's on the gas pedal. Will it be inflationary? That's probably her real concern here. It is a concern. The hard monetary school will say you're going to inflate. That's exactly what they said in 2008 and 2009 when Helicopter Ben again did what's happening now, put a lot of money into the system. Did we inflate? No, we didn't. Dr. Lacey Hunt probably best describes that. You can Google him, or Van Hoisington, a phenomenal bond manager. I think Van manages a couple of billion, $3, $4, $5 billion. You can read their report on why we didn't inflate. And I don't think we will inflate this time either. If you realize we're in a fiat currency, the sudden increase in money supply is not necessarily inflationary. If we're in a hard money system, which we're not, then it would be inflationary. So I think that a lot of the Cassandras out there have this fear of, oh, the Fed. The Fed has a distinct job, a mandate from Congress to maintain a steady economy. And when they see things like what we saw this year, they step right in, and I think they'll save the day. And this comes from a guy who years ago was not a Fed believer or Fed backer. I thought they were out to get us. I don't think that any longer. They've done, give them some credit, give them some due. They've done a pretty good job of regulating the economy, and I think they'll do it again. And also, you can look at the inflation forecast the Federal Reserve System does and see what the driving force of inflation in the last 10, 15 years has been crude oil, not money supply. When money supply has increased, we haven't inflated. When crude oil has gone up, we have inflated. So what's crude oil doing now? Inflation. I don't think it's coming.
Excellent. I think Roland, I think that could be the last question.
Yeah. Actually, well, Larry, do you want to just take two more and then
Sure,
wrap it up?
of course.
Okay,
Yep.
so these are the last two questions.
Okay.
So Phoenix is asking again, between your trades, which one's more profitable, the ones where you hold for weeks or the ones that you hold for months?
Well, I don't hold many for a month, so usually I'm out at probably 15, 20 days. And I'd say accuracy and all that, they're pretty similar. I might get a bigger trade the longer I hold it, but I'm usually out within a month or so. I don't have a lot of trades that are months, other than our stock investing where we hold for a long time period. Yeah, those can be some pretty big trades.
And then the last question is, the stock market doesn't seem to correlate with the real economy right now.
Right.
Is there a reason?
Stock market never correlates with the real economy. The stock market tops before the economy gets bad, it bottoms before the economy gets good. Don't confuse it. As I said earlier, look at those PowerPoint slides. Look at what the Federal Reserve System said. They said there's no correlation between GDP, gross domestic product, and the stock market. So people they start looking at the wrong thing. They get out of look at the stock market. That's where you're going to make your money. Everything else is propaganda. It's all propaganda except what the market's doing. That's what you have to focus on. It's the market. And you read, especially now, all the news is so negative. This is everything is bad. Everything is negative. Forget the naysayers, the purveyors of pessimism, the Cassandras. Look at what the market's doing. There's the answer. And with that, I'd like to thank everybody very much for being here. Bobby, thank you. Roland, thank you very much for having me, guys. And to all of you, I wish you good luck and good trading. And thanks again for this opportunity. I really do hope all of you have a great time trading, and that it becomes as much of joy for you as it has for me over the years.
Thanks so much, Larry, and
Thank you,
for
guys.
taking the time. All right. Well, everybody, this concludes our program, and we'll see you the next time at the next event. And thank you for taking the time. Good night.
Good night.
Good night.